Hello, everyone. I'm Brett Carleton, coming to you from the offices of Heritage Wealth Management. This past quarter has been a prime example of why we can't make investment decisions based upon the general consensus. At a time where everybody is screaming about this pending recession, we are seeing the economy grow actually quite robustly. Employment remains strong, and the U.S. equity markets continue to go up. So I've talked about, really post-COVID, this normalization process. And whenever we go through any type of an economic event, we have to go through a normalization process to get from the panic phase to a more normal phase. And we just don't have any idea what it's going to look like this time because we've never been through anything like this in recent history. Going from shutting down the economy to just dumping trillions of dollars into the economy to trying to get things back to normal. And I think 18 months ago, all the talk was around inflation. The Fed has raised interest rates. They've done things to slow growth and bring inflation back into closer to a normal range. And I think we'll continue to see that as we work through this. But who would have ever thought that we'd have had all the travel this year, that consumer spending would remain so strong, and employment would be so strong during all of this? So I just think it's going to take us well into next year until we figure out what normal looks like from an economic standpoint. Companies are having a hard time figuring out what consumers want because during COVID we bought stuff. Then as we had the reopening post-COVID, which was very uneven, people wanted to get out and do things. And the last 12, 15, 18 months have all been about travel. So companies are, now we don't have the supply chain issues that we had before, but companies are still struggling with what consumers want. So I think that is going to be just part of this process. Now I mentioned the Fed earlier. The Fed has raised rates, they've paused. They haven't say they're going to hold rates higher for longer, which again makes money more expensive, which helps to slow down consumption, which ultimately should help with inflation. At the same time, they are taking out money out of the economy. If you remember back to during the pandemic, the government put about 40% extra money into the economy, so it was a huge monetary expansion. They're reining that back in, which means less money available. So again, doing things to try to slow purchases, slow consumptions. And we still potentially could go into a recession. I just don't know that it would be a deep recession because I do think companies will be reluctant to let people go like they have in other recessions because it's been so hard to find new employees as we've come out of the recession. The other thing is companies, banks, U.S. consumers, everybody has fairly strong balance sheets. So I don't think if we were to go into recession, it would be a long recession. But I don't think we can rule out a recession at this point. Back to inflation, the one area that we're seeing just unrestrained spending is Washington. There just seems to be no fiscal restraint whatsoever. Actually, one of the rating agencies, Fitch, actually downgraded U.S. debt this past quarter. And I don't know what it's going to take for us to get a handle on that, but we can't continue to spend money like there's some type of an emergency. So we'll see what's going to happen there. But right now, there are many reasons to be very optimistic about things because if we go back and look at China, pre-COVID, they try to cover up COVID. They've lied to us about COVID, and essentially every company that manufactures in China right now is looking to divest themselves of at least some of their manufacturing in China. And we're coming up with new terms. We've heard of reshoring, which is bringing manufacturing back to the United States. But now we have friendshoring, which would be moving manufacturing to countries that are more friendly to us, or at least the global trade, aka India or Vietnam. And then also nearshoring, bringing production and manufacturing back to Mexico and to Canada so that we don't have to export things all the way across the ocean to get here. So that will be a trend I think that we'll continue to see. And it's a positive trend. It will help to stabilize our supply chain so that we're not so dependent upon just one country. But I want to take a second and talk about this reshoring because the semiconductor space is something that we've heard a lot about. It's been in the news, it's been part of this Inflation Reduction Act, money for producing chips here in the United States. But it's estimated right now that there's at least $250 billion of construction on these chip plants here in the United States. And I've actually heard numbers that's as high as $400 billion. Well, right now that means jobs, that means a growth of GDP because we're manufacturing, construction, all of that. But what that means ultimately is long term, those are construction jobs, manufacturing jobs, and then also real security here for us in the United States because we'll have a supply that is here and we don't have to depend upon another nation to provide that for us. And it's not just happening in semiconductor space, it's happening all across the manufacturing sector. So that's a very, very positive trend that's taking place, and I think will continue for years to come. The other trend is just employment. So employment remains strong, and if people have jobs, they spend money. So I think that's very, very bullish as we look forward. Another indicator is just the amount of cash sitting on the sidelines. Again, a very bullish indicator is when people are afraid, they park their money in cash, but eventually they get it back invested in the markets. So sometimes there's a lag, but that's a very, very bullish indicator. And right now, consumers are getting paid to hold cash, which is a positive for us because our fixed income piece of our portfolio, think of bonds, has been a real drag on our portfolio for the last several years. Well, now we can make real returns in that part of the portfolio. So that has been a benefit to the Federal Reserve raising interest rates as we move forward. Now, we're already well into the presidential election cycle, and really I just want to say, as I always do, we have to limit how much media exposure we have because study after study just shows the more media exposure we have, the more negative what a person's outlook is. So as responsible citizens, we have to get enough information to decide who we're going to vote for, but then limit it with that because it's going to be probably a very long, contentious 13 months. So as just a parting thought, remember, we invest in the greatest companies in the world. We don't invest in countries. So remember that. Obviously, as citizens of the U.S., we hope for the best, but we're going to invest in companies that are going to figure out a way to make a go of things. So as always, I welcome any comments or thoughts that you have. And thank you for your time today. Have a good afternoon.